Most business owners think tax planning is about paying less, but it's not. It's about creating leverage, the kind that multiplies wealth faster than any investment return ever could. And that leverage doesn't come from deductions or loopholes. It comes from structure. Here's the truth. Most CPAs don't build structure. They file history. They report what happened. They don't design what could have happened. That reactive approach costs business owners 30 to 40% of their profit every single year. Think about that. If your business makes $1 million and you're overpaying by even 20%, that's $200,000 gone every year. That's not a missed deduction, it's a missing strategy. Most firms focus on compliance, making sure the forms are filed correctly. At Quantus, we focus on design, making sure your financial architecture produces leverage. Leverage, in simple terms, means using less to do more. In finance, it's borrowed capital. In taxes, it's retained capital. When your structure reduces how much leaves your balance sheet, every dollar you keep becomes another dollar that can work for you. That's what private equity firms, family offices, and institutional investors all understand. They're not necessarily earning more, they're just keeping more, faster, and they're redeploying it in ways that compound. Every dollar you save in tax is another dollar you can reinvest. And every reinvestment produces new returns, new deductions, and new opportunities. That's what we call financial leverage through structure. You're using the tax code as a multiplier, not a penalty. Let me give you an example. We worked with a 7-figure business that was structured as a pass-through. All of the income flowed directly to the owner and was taxed at nearly 40%. Instead of changing the operating company itself, we added a management company, a C corporation, that contracted with the operating business under a management services agreement. That single move legally shifted a portion of profit from the high-tax operating entity into a tax-advantaged structure. The MSO paid tax at 21% instead of 37%, and the retained earnings stayed inside the corporation to be redeployed. But we didn't stop there. We created a relief valve, a way to extract those retained earnings from the C-Corp without triggering dividend tax. That liquidity could then be accumulated and reinvested into new opportunities, real estate, energy partnerships, or alternative funds, each designed to generate fresh deductions and new income streams. The result? Roughly $400,000 less in annual tax. Over 8 years, more than $3 million remained in play. Capital that kept compounding rather than being lost to the IRS. That's leverage. Not financial engineering, just intelligent structure. The goal isn't just to pay less tax, it's to create more capital to work with. Because when your money doesn't leave your balance sheet, it compounds. That's how wealth actually builds. Most people chase income. The wealthy chase retention. That's the shift. From earning more to keeping more, and putting every saved dollar to work. Structure is what makes that possible. It's not about what you make, it's about what you're positioned to multiply. So if you're running a 7-figure business and you're still thinking about taxes as a bill instead of a lever, you're missing the point. Leverage isn't borrowed money. It's smarter structure, and it's the foundation of everything we build at Quantus. To see how your structure could create leverage, compounding, and growth, book a call with us.